If you have just tuned in, this is Econo Chat. Let's talk business with Mr. Daniel Steinman. We are talking about Trumponomics. The impact that has been going on in the world, not just Namibia or not just Africa, but the whole world on Trump since he has been elected into office as the United States president. We are talking the interest rate impact on Africa, how that really affects Africa, but also like Mr. Daniel Steinman said before we went on the short break, is that liquidity has no border. Yeah?
Very true. So what happens? Interest rates in the United States suddenly go from near zero or practically zero for the past 15 years, from 2009 with the big international recession. The Federal Reserve brought interest rates down aggressively, and it was there at, I think, 0.75%. It was less than 1%. So effectively zero for the better part of 15 years. So people got used to that. So that generated a lot of liquidity in the American market. But also the last 15 years was the third phase in the whole globalization movement that started roughly more or less 1985 to 1990. That is when globalization, with the formation of the WTO, the World Trade Organization, in 1994. That was the first formal step towards globalization. To get rid of borders, to introduce free trade as much as is possible. That also applied to financial services. It means that if I buy stuff from China, the Chinese producer wants to be paid in China, otherwise it doesn't send me that container. You know? So if you want to globalize the world in terms of trade, you also have to globalize the world in terms of finances, because all the stuff that you bring in from all the other countries have to be paid for. Very simple rule. You want what we produce, you send us a couple of dollars. You know? And I'm actually sounding as if I'm joking about this. In a sense, it's always not hilarious, but humorous to me, because it developed a momentum of its own over the years. And it's not a short period; it's 30 to 40 years that this happened. And if I'm using the example of trade, but if money can flow across a border to pay for things, money can also flow across a border to go into an investment instrument. And that is a mouthful, but all that it means is that I can go buy American government bonds in New York or in Chicago, and I can go buy Euro bonds in London, and I can make any type of investment that I want to with my Namibia dollars or my South African rand, provided I follow the right channel, and I can send that money anywhere. That is liquidity. Now, what happens is a very common sense thing. Since 2009, with interest rates practically zero, you found that there was this phenomenon that we refer to as the hunt for yield. And all that it means is that investment managers were looking for investment instruments where they could earn more than the policy 0.75% that you could earn in the American money market. So investment capital, money, flowed to investments wherever the interest rates were slightly higher. And it was very beneficial to Africa, to any third world market. These are the big markets in Africa, like Kenya and Nigeria, South Africa, but also North Africa, Morocco, Egypt, and then markets like Argentina, Mexico, Turkey, Vietnam, Malaysia. They all depend on liquidity, the availability of money. And it became easier and easier to sell their own government bonds into an international market because the liquidity constraints, that what prevented money in the old days from flowing between countries, was becoming less and less and less.
Yeah.
So, but it also means that wherever there's the highest return, the money flowed in that direction.
Yeah.
That's why we're very fond of talking about foreign investment without really knowing what is foreign investment, And that's exactly what it is. Foreign investment in a Namibian context is not necessarily a factory.
Yeah.
It may be a little bit in mines, but the big thing is the capital market. Money that comes in from people outside Namibia, investors who like Namibian government bonds, who want to bring their money in.
Yeah.
So now you have like a seesaw, like a balance, like a scale. If the interest rates in the United States go from 1% to 2.5%, that is a 150% increase. It means that if South Africa, Namibia, Botswana, Zambia, Zimbabwe, if they want to keep the volatility in their own market, they have to increase their interest rate
as well
by 150%. But the interest rate wasn't 1%.
Yes.
It was 5 or 6 or 7%. Now go work out 150 on that. So suddenly you now get to the point where local interest rates have to go up to prevent all the money, all the investment money from flowing back to the United States market, which is like a huge sponge. They adjust their interest rate by 0.15%, 150 basis points. And suddenly you see the rand going for a tank, decreasing in value, getting weaker. And you see the effect on the Johannesburg Securities Exchange. So remember when we started talking, I said it's all about interest rates.
It is.
So what we need to watch in the next 6 months is inflation in the United States and the interest rate reaction based on that inflation, because that will determine where our interest rates will be.
And that is Mr. Daniel Stamman leaving us with that task to watch that space in the next 6 months. And I hope that you will do that. We say thank you because we have to unfortunately say goodbye. So thank you from our team, and thank you to Mr. Daniel Stamman as well.